Now let's see scope and objective of financial management, types of financing. Okay, right. So finance management is a vast area. That's the role of CFO is going to start. Here we're going to study about what are the different types of financing the company can have. Similarly, what is the objective of financial management? Why we need financial management? Why there is a scope? What do you mean by financial management? What is the scope of financial management? Why there is a CFO required for each and every organization? What is the importance of him? What are the various sources of financing? These are the areas we are going to study now. Right. Let's see one by one. The first paper, right. Explain the two basic functions of financial management. There are two basic functions. Primary, the finance manager have a two role to play. Primary, see there are a lot of functions they're going to do, but apart from this, there are two primary functions. Number one, procurement of funds. They have to procure the funds. Funds are available outside, correct? No. So capital available, loans available, debentures available, but they have to bring the funds to the organization. Similarly, effectively you have to put the funds into usage. There are two things. One is called procurement of funds, number two, effective use of funds. That's it. So these are the two primary areas the finance man is focusing on it. Number two. Let me start with that. So what are the various ways in which procurement funds can be started? Number one. So as a finance manager, you must know, you have to identify the source of finance, where the finance available. Number one. Number two, you must know the finance mix. So for example, you know equity share capital, preference share capital, and debt market you're having. So can you combine equity with the debt? Can you combine preference with the debt? Can you combine 60% equity and 40% debt? So this is called finance mix. Or 30% equity, or 20% preference capital, and 50% debt, right? So it's called finance mix. So you have to determine the cheaper source of finance, then you have to fix it. Number three, raising of funds. How to raise the funds? Okay, funds are available. How to raise the funds? How to bring the funds? The finance manager must know. That's it. Number four, how the profit to be distributed. So division of profit. So profit to be distributed, it can be transferred to general reserve or any surplus available. It can be given to the shareholders in the form of dividend. And finally, the company can be able to retain it also. That's it. So that's it. Retention of profit. Okay. So before you proceed, I'm telling the basic function. There's a lot of ways we're going to use it. First, to the primary area, the crown of the company is called sale. Without sale, no company can be able to survive. That's called sale. Sale minus variable cost. So generally, what is variable cost here? Material, labor, overheads. For example, I have a pen, digital pen. Okay, digital pen I am having. For example, in the digital pen, the cost of digital pen is going to be 1,000 rupees. Imagine. What is the variable cost of the pen? Generally, material involved, labor involved, and other expenses. Manufacturing, office, administrative, selling expense involved. That is called overheads. Material labor overheads involved, so variable cost. For example, variable cost is supposed to be 300. So 1,000 minus 300, sales minus variable cost is equal to 700. Right. So the difference is called contribution. You already studied in your costing paper contribution. Minus fixed cost. So fixed cost is supposed to be, for example, 200 rupees fixed cost. Maybe fixed rent, fixed salary, anything fixed. It never changes irrespective of output. So 700 minus 200 is equal to 500. That is going to be EBIT, earning before interest and taxes. So minus interest. For example, 100 rupees have to pay interest. The company borrowed loan, so they have to pay interest. For example, 100 rupees loan. 100 rupees interest they are paying, it's the borrowing cost. EBIT minus interest is equal to EBT. So 500 minus 100 is equal to 400. It is called earning before tax. This is earning before interest and taxes. We are going to study everything in terms of leverage section. Maybe after 4th chapter, 5th chapter, we are going to study thoroughly these units. Minus interest is equal to EBT. So minus tax. Tax is equal to, for example, 20% tax. So 30% tax. That is going to be, say, for example, 120. Out of 400, 30%, 120. So tax you have to pay out of your earnings. 400 minus 120 is equal to 280. So this is equal to PAT, profit after tax. This profit, from the profit available sufficiently, can we pay preference dividend to the preference shareholders? The preference dividend we have to pay. For example, 80 rupees I'm paying preference dividend. So balance is equal to 200. It is called earnings. So these earnings, either it can be given in the form of equity dividend to the equity shareholders, or the company can able to retain the profit. Or it is called retention of profit. That's it. So here, see the line. Division of profit to be distributed, either preference dividend or equity dividend. Or retention of profit. The company can able to retain it also. That's it. Okay, right. Similarly, various sources of procurement funds is equal to share capital. The company can able to raise share capital. The company can borrow debentures, or borrow means borrow loan or issue debentures. Debenture also just a debt instrument, just like loan. We can get the funds from the banks, from any financial institution. American depository receipts, ADR, we're going to study later on. Similarly, global deposit receipts, foreign direct investments, foreign institution investors. These are the various ways in which the funds can be coming into the business. Every source of funds, there is a limited risk also available. There is a cost also available. You must have to control it. There is a risk, there is a cost, there is a control. Each and every funds. Risk available. You can't get the funds easily. Same time, there is a cost of funds also available. Similarly, you have to control it. You have to control it. Okay, unnecessarily cannot borrow anything. Correct? No. There is any requirement, you borrow. Always don't borrow. That's it. So what will be the source? The cost of fund should be minimum. That's it. You try to balance the risk and the control function. Right? Number one, procurement of fund. Number two, important thing, how effectively the manager has to use the funds. Okay, the money they have 1,000 crores money available. How the fund has to be used? The fund once procured cannot be left to remain idle. It cannot remain idle. It has to be ideal, not idle. Should not be rest idle, which means, for example, we lock it in the cash box. Cash has been remaining idle. There is no use at all. No, correct? No. Automatically, the funds has to be invested in such a way so the maximum return we have to give. Say, suppose you have cash available. Can you go to the bank and deposit? So the cash earns some interest, correct? No. Similarly, you have money available. Can you invest somewhere else in the form of any capital budgeting, any investment, the machinery, land, or any business? So by the way, it is going to give some return. That's it. Along with the solvency also, we have to check it out. Which we have to always maintain solvency. So once a business started, it has started forever. It never goes for any insolvency. That's no. So you have to check with the solvency also. This is the effective use of funds. That's it. Similarly, at the same time, the fund should be maintained to meet the working capital requirement also. That's it. So what are the funds available? Either you can invest in machineries, plant, land, and buildings, or we can give the money for working capital requirements. What is working capital? Day-to-day expenses, we need some money, so that money can be used. In simple term, working capital is equivalent to current asset minus current liability. What is current asset? So what is the money we have in a short period of time in operating cycle? What the company owing money in operating cycle is called current assets. Example, stock, data, receivables, prepaid expenses, accrued income, TDS credit, just like this. What is current liability? Within operating cycle, what is the commitment? You have to pay creditor payment, you have to pay payment for bank overdraft, outstanding expenses, then similarly short-term credit. So these are things current liability. So difference between current asset and current liability is equal to working capital. So in simple term, as a layman language, what is working capital? So if you want to run the business efficiently, so after meeting current asset and current liability, what are the money left over that you can use it for day-to-day expenses? That's called working capital. Similarly, the funds can be used for working capital. Funds can be used for investments. Okay, so don't invest too much in inventories. There are a lot of companies, they invested too much in inventories. Stock they invested. So unnecessarily, you have such a huge stock available without using the stock. Purpose not going to be solved. No. So don't invest too much in inventories. Don't invest too much in the book dates, which means debtors. Don't invest too much in cash. That's it. Similarly, the funds can be used especially for utilization of property, plant, equipment. Either you can purchase PPE. That's called accounting standard 10 says PPE, investment in the fixed assets. Similarly, it can be used for working capital. It can be used for working capital. That's it. These are the two primary purposes. Either it can be invested in the capital budgeting, either property, plant, equipment, or any process, or any project, or it can be used for utilized for working capital also. That's it. Now let's see. Next paper, discuss the changing scenario of financial management in India. See, financial management is a dynamic field. It is not a static one, dynamic. It's ever evolving, ever changing. That's it. So, definitely automatically, there is a lot of scope and available. It's a changing in financial management. Right? So, it's called modern financial management. It's not a traditional finance, it's a modern financial management. Okay. So, modern financial management has come a long way from a traditional path of corporate finance. Now, the economics is opening up. Now, every company become global, think local, think local and work globally, or work local and think globally, just like this. Now the economic is opening up, so global resources are going to be tapped. Okay, similarly, a lot of option available for the finance manager have no limits. Sky is the limit for finance manager nowadays, no limit. So it's going to be a lot of changes here, especially it is the excitement as a finance manager. Once you're coming through the finance meet, it's going to be excitement. Every day there is a challenge available, he has to face it. A large part of finance are carried out nowadays. Number one, now the interest rate freed from the regulations. Interest rate will be freed from the regulation. That's it. Regulation as a treasury operation also. It has to be more sophisticated. Interest rates are always fluctuating. That's 200% true. So RBI is going to fix the interest rate. Because repo rate and reverse repo rates are available. Correct? No? Fine. So what rate the banks are going to get the money from the RBI? No, the rate is called repo rate. Suppose the banks are having excess cash, so that money is going to be parked with the RBI. It's the reverse repo rate. So RBI will pay interest to the banks, reverse repo rate. The bank will pay interest to the RBI, it's the repo rate. So by the way, a lot of regulations available, especially treasury functions, right? Of interest rate freed also one of the important functions of finance manager. Now the rupees become fully convertible. We can easily we can convert it. Rupee convert into dollar, dollar can be converted into rupee. Similarly, nowadays, so you have to be very thorough in the forex management also. Finance manager have a role to play in forex management, foreign exchange management also. The export imports, no. Normally through dollar, yen, yuan currency, Malaysian ringgit, just like this. Similarly, optimum debt mix equity you have to maintain, which means your debt and equity, you have to maintain it always. Similarly, you have to maintain the share prices, that is very, very crucial, because the company's dividend policy is going to alter the market price of the shares. Okay, the finance manager have to be thorough knowledge of the dividend policy. So we are going to separate chapter for dividend issues. We'll see later on. Dividend policy very, very important. Similarly, the bonus policy also. So these are the core areas where the finance manager have a role to play, especially. So dividend policy and the bonus issue directly going to impact on the share price in the market. Once a company giving dividend, share prices increases. Once a company giving bonus, share prices increases. But directly there is impact on the share prices. Similarly, share buyback and reverse book building. These are the areas also the finance manager have to concentrate. Share buyback. Excess capital cash available in the company. Can the company can go for buyback? Yes. The company can go for buyback also. That's it. Even reverse book building, especially for raising the funds. Similarly, the company can also raise the funds through ADR route, American deposit receipts. Similarly, global deposit receipts. So that's available, available. The company, now a lot of Indian companies going abroad, especially America, to tap the funds from American capital market to bring into India. That's called ADR. Similarly, Indian companies going globally, tapping the funds from the international markets is called GDR, Global Deposit Receipts. Similarly, there is other area the finance manager can have a huge role to play, risk management. So there is a risk in the business, risk in the operation, risk in the finance. So nobody can able to predict it. What is going to happen now? For example, in Russia-Ukraine war, no. But there is it's very tough. Life risk. There is a risk of life in Ukraine, correct? No. So the people escape from Ukraine nowadays, correct? No. But automatically there is a risk available. Risk in the business sense, risk in the operations, finance sense, that's it. But automatically, even in the share market also, option trading available, share market trading, future trading also, risk available. The money can go, money make simple. So for example, one wrong decision going to vanish your entire money. So there's a portfolio manager, the finance manager, a role to play, especially in option and future trading. Similarly, in free pricing, in book building of IPOs or any equity offering or any treasury management, these are the modern area where the finance manager have a role to play. Treasury management, pricing, risk management, raising the resources, buyback issue. Okay, debt mix, optimum debt mix he has to keep into mind. Similarly, fully controlled rupee factors. So these are the areas the finance manager have a role to play. That's it. Okay, let's start with one. Next, 17-18 paper. What is finance function? Finance function. So generally, finance function is the most important function of all business enterprise. If you take the business enterprise, what are the roles available? HR manager, personal manager, HR manager, marketing manager. Okay. Similarly, sales department, marketing department, HR department, finance department, securities. So a lot of departments available. Correct? No, that's it. Chief people officer, chief welfare officer. Similarly, like production department. Like, but one of the important functions of any business is the finance function. That's it. So finance is the core, because if you want to set up the enterprise, you need funds. Especially the finance manager, finance function is always concerned about raising of funds. Similarly, as a finance function, where is the cheap source of finance? That's it. For example, if you're raising debt, you have to pay some higher interest. Raising equity, you have to pay some higher cost of capital. You have to raise the funds only cheapest rate. Similarly, how the funds are going to be raised. Similarly, you have a provision for refund also. That's it. Whenever the money is not required in the business, don't keep the money with you. Please refund it. At least the cost of capital also will be reduced. And the money is not required, don't give the money with you, refund it. That's it. What is the most profit investment available? Please invest it. How to manage the funds raised? Whenever the funds raised, you have to pay returns to the shareholders, returns to the bankers. Okay, in the form of interest or in the form of shareholders, means dividend you have to pay. That's it. Similarly, how much risk is the company going to take? See, if there is a risk, there is a return. No risk, no return policy. Always the company has to take the risk, then only return can be provided for the funds. That's it. Similarly, how to acquire the funds, how to utilize the funds, how to increase the profitability for the organization. Funds are available, take the funds, use the funds, make the profit, and maximize the company value. That's it. So create wealth for the shareholder. That is ultimate aim. Raise the fund, utilize the funds, increase the profitability, maximum value for the company, maximum wealth creation for shareholders. Maximum wealth creation for shareholders. That is the ultimate aim of any finance manager. Ultimately, create wealth for the shareholders. Don't think about the profit. Profit, one of the important parameter, but that is not ultimate aim. Ultimate aim, you have to increase the shareholders' wealth. That's it. So there are three basic finance functions. Number one, investment decisions. Number two, finance decisions. Number three, dividend decisions. So these are the three important decisions the finance manager has to take. Similarly, it's called finance function. Investment decision, finance decision, dividend decision. That's it. Where to invest, how to raise funds, how the dividend is to be distributed. That's it. So let's see one by one. What's investment decision? What is investment decision? Number one decision, investment decision. Three important decision. The finance function is called investment, financing, dividend. Investment decision means once the funds procured, yes, I raised funds. How the funds are going to be allocated to different projects, for this, we have to take proper investment decision. Project A, viable. Project B, not viable. Don't invest. Project C, viable. Please invest. Just like this. You have to select which project is viable, which project not viable. Invest. Investment decision is one of the important things. Careful analysis of various projects to be taken into consideration. That we are going to study everything in the capital budgeting, especially net present value, project profitability index, cost of, similarly, we have to find the cost of capital, internal rate of return, simple payback period, discount payback period. So these are the areas we're going to study in capital budgeting. And similarly, how much risk the finance manager has to take. That's it. Once the proposals are accepted, so you have to get a reasonable return on capital employed. We must know ROC. We must know ROC. What is ROC? What is the return you're expecting on your capital employed? So ROC means return on capital employed. That is nothing but return by capital employed into 100. When you study everything in the ratio analysis, what is capital employed? CE, capital employed, which means shareholders funds plus long-term borrowings. Okay, that is debentures, loans, just like this. Similarly, shareholder funds, share capital, reserve surplus, or surplus, just like this. But shareholder funds and long-term borrowings is equal to capital employed. Capital employed, one more term, it is called long-term funds. Right. Above you have to get reasonable return for the capital employed, ROC. ROC equal return by capital employed. Return is equal to EBIT. Return equal to EBIT. EBIT by capital employed into 100. For example, your capital investment in the business is going to be 100. Your EBIT is going to be 15 plus 15. Out of 100, 15 is EBIT. What is the rate of percentage? Is going to be 15%. That's it. Similarly, next one, finance decision. Number two decision, finance decision. You must know which is viable, which is not viable. The finance manager has to think and he has to invest very carefully. Finally, he has to get ROC for the project. He has to get the ROC for the project. Return on capital employed. That's it. See, if you invest in the bank getting interest, correct? No, that is a return of investment. Similarly, shareholders also, it's hard earned money for the shareholders. They invested into company. You have to give best return for them, correct? No, that's called ROC. Correct? Number two, decision, the finance function is called finance decision. That's it. So various sources of funds available. What are the best source of funds? Either can we go for debt market, debenture issue, or can we borrow loans at a cheaper rate, or we can issue equity capital, or we can raise preferential capital. What are the best source of funds? That's it. What is the cost involved for the preference capital? What is the cost involved for the equity capital? What is the cost involved for the loans, debentures? About the best selection of sources, that's very, very important. There is a need available, purpose available, object you have to think, cost. So these are the parameters you have to think. Based on the parameter only, the best source of funds you have to select. As a finance manager, you have to make the proper balance between the long-term requirement and the short-term. Long-term, sir, 5 years I need amount. Long-term requirement. So next 3 months I need amount. Short-term. As a finance manager, you need to have a mix. This is my long-term requirement funds, short-term requirement funds. Similarly, proper mix of loans also. Sometimes loan will be cheaper than the debt will be cheaper than the equity. Our finance manager has to raise debt. Sometimes own funds will be cheaper. The finance manager can go for own funds also. That's it. Number 3, dividend. Last one. Ultimate aim of any finance manager, create wealth for shareholder. That's ultimate aim. As a finance manager, you have to decide whether or not to declare dividend. Can we declare dividend or not to declare dividend? That is my part. If dividends are going to be declared, what portion to be paid to the shareholder? Okay, dividends are going to declare. It's a fixed. And what is the amount we have to pay to the shareholder and what the company can able to retain? I told you no. Here, please check it out. I told you here. A portion of the earnings can be given in the form of equity dividend, or some portion of the form will be in the form of retained profit, retained earnings. That's it. Either one portion can be given in the form of equity dividend, other portion the company can able to retain it. Retained earnings, the company can use it for any future investments. But ultimately, a portion can be given to the shareholders in the form of dividend, The other portion, the company can able to retain it. That's the main thing. That's it. What are the two main aspects of finance function? Number one, investment decision is one of the important thing. That I told you there are two types of finance function. One is called long-term finance. Always a finance manager have to think the long-term viability. Similarly, short-term also. Short-term means especially working capital management. That's it. Long-term means he has to think about the investment decisions. Already I told you, investment decisions, finance decisions, and dividend decisions. So these are three important areas. Long-term finance decision, the finance manager think about it. Number two is called working capital management. It is nothing but so current asset minus current liability. That's it. What is current asset? What the company owned for a short period of time. That's the current assets. Example in the form of investment, the short investments in the stocks, especially data, receivables, and cash and bank. So these are called current assets. So what the company going to pay in the operating cycle is called current liability. So difference between current asset and current liability is equivalent to working capital. That's it. Next. So can you tell me the difference? This is a 21 paper. State any 4 tasks involved to demonstrate importance of good financial management. What are the 4 important tasks available to demonstrate the importance of good financial management? Number one. This is the important task. Okay. The best way to demonstrate the importance of good financial management. What are the tasks available? Okay, you're telling this is financial management. What are the tasks available? Number one, very, very important, taking care not to overinvest in fixed assets. Very, very important. See, this is your requirement fixed asset. 1 crore, I'm going to invest in fixed asset. Why you have to invest in 2 crores? Unnecessary, no. About don't invest too much in fixed asset. Take care. Similarly, you know exactly what is your inflows, what is your outflows. You have to balance it. What is your inflows and what is your outflows? You have to balance it. Similarly, ensure there is a sufficient level of short-term working capital. That is very, very important. So always ensure don't have any shortage of working capital. If working capital in shortage means company cannot able to survive for next 3 months or 4 months. So you have to pay salary, rent, EB, everyday expense available. Correct? No. A company always have sufficient funds available for short-term working capital. This is very important. Similarly, and he has to ensure and he has to demonstrate. The finance manager has to demonstrate. Good financial manager has to demonstrate. We have to always target the sales revenue. Revenue is very, very important. Always target the sales. And you have to deliver the growth. You have to deliver the growth. That's it. So target the sales and deliver the growth. That's it. Deliver the growth. Growth is very, very important. Okay. Growth is very, very important for the company. Target the sales, meet the sales target, and always think about the growth also. And the gross profit, you have to increase it. Gross profit, you have to increase it. Similarly, you have to correct pricing. Every product and service, please correct the price. Don't charge too much amount. Too much of price means customer will go away from you. Your product will not be in the market. Correct? No. So don't charge too much price for the products. Don't charge too much price. Correct the price. Get the profit. That's it. You know what price you have to charge for a given product, what profit you are going to earn. So try to increase it. You try to increase the gross profit margin by selling the volume. You focus on the volume. That's it. Similarly, controlling level of general administrative expenses by finding more cost-efficient ways of running day-to-day business operation. That's very, very important. Similarly, if you want to run the day-to-day business operation, cost effectively you have to do. Don't invest too much in general expenses. Don't invest too much in admin expenses. You always, every day you want to run your business more efficiently, cost effectively. That's it. Control those expenses also. Control those expenses also. Similarly, so minimize the taxes the business has to pay. Don't pay too much of taxes. I'm not telling you try to evade the tax. I'm telling you try to avoid the tax. Tax planning, tax management. I'm not talking about tax avoidance. I'm not talking about tax evasion. Okay, tax evasion is illegal. I'm talking about tax planning and tax management. You know the loopholes in the tax system. So I can able to tax plan, I can able to manage, I can avoid. That's it. Minimize the tax the business has to pay. That's it. So these are the important tasks. So good financial management has to establish. That's it. Similarly, this question has been asked in 4 times, 3, 6, 9, and 10. So 2003, 2006, 2002, 4 times the same question has been asked. Recently, 2018 also they asked. What is the difference between profit maximization and wealth maximization? What is the difference between profit maximization and wealth maximization? So business is all about procurement and use of funds. Very clear? How the funds going to be procured? How the funds going to be used? That's it. That's the main purpose of any financial management. Procure the funds, use the funds. That's it. So one important thing, profit maximization and wealth maximization. Profit maximization, one of the objective, not the ultimate one. Ultimate one, wealth to be maximized for shareholders. That's it. In profit maximization, the business has a two main objectives. Number one, so profit is going to measure of efficiency, correct? Every business, they need profit, correct? That's a yardstick. So it's a good business, which means the company have a good profit. Profit acting as a measure of efficiency for each and every business. Even if you're running any tea shop, profit is very, very important. If you're running any department store, profit important. If you're going to run any 1,000 crore business, profit important. So profit is a measure of efficiency. At the same time, it is going to protect, it's just going to give the protection against the risk also. It is a good measure of efficiency, protection as a risk also. These are the two important things. That's a profit. So profit, measure of efficiency, profit as a protection of risk also. A company having profit, no risk. That's it. Similarly, there are some people, they always think about profit maximization. That's it. Agreement in favor of profit maximization. That's it. Any business going to run successfully, the ultimate objective of any business, it is going to be profit maximization. But there is a shift that the old theory says profit maximization. Now the new theory says wealth maximization. Profit maximization is one of the objective, but ultimate aim, wealth maximization for shareholders. Similarly, future is uncertain. Tomorrow what is going to happen? Nobody knows. So the firm should have earned more in profit today to meet the future contingencies. Tomorrow, what is going to happen tomorrow? Nobody knows. Suppose you have to invest more in profit to meet the future contingencies. That's it. The main source of finance for growth of business profit is a profit. That's true. That is very, very important. A business is so successful because they have a profit margin. A business is weak because no profit for them. That's it. Their cost is more than the profit, sales, no profit. The sales is more than the cost of profit. Above, there is a growth for the business. Now, always you have to think about the profit. That's it. So profit maximization is very, very required. Similarly, profit maximization means you have to think about the grounds for rationality. It means efficiently economic prosperity. It's a measure. Profit, measure of efficiency of the business. Profit is a measure of economic prosperity. How well the company is going to be because of profit only. How well the Tatas are because of profit. How well the Ambanis because of profit. The economic prosperity of a company lies in profit. Efficiency of the company lies in profit. The profit maximization is going to be a measure of efficiency as well as economic prosperity of the company. That's it. So these are advantages for profit maximization. There are some arguments against profit maximization. There are some people always think about negative about profit maximization, which means workers are exploited, long working hours for workers. By the way, we exploited the working hours of the workers. Maybe if 10 to 15 hours they have to work every day, but low wages for them, we exploiting wages. Argument against maximization. Similarly, we're going to exploit the consumers also. Here, we're going to ignore the risk attached with the profit. So we are normally, whenever the profit is going to earn, there is a risk attached. Risk is always ignoring. So workers, very, very important. Risk. But we are just ignoring the workers. Health. Consumer also very, very important, but we are ignoring the consumers. So profit is a vague concept. Most different to different people. Profit is a vague concept. Everybody thinking profit is a different way. My way of profit is different. Your way of profit is different. So vague concept, different for the different people. Similarly, it's a narrow concept. So cost of social and moral obligations available. So profit maximization as an objective. Financial management. It is going to be inadequate. That's it. Okay, right. So profit maximization is going to be objective of financial management, right? So these are the against theory, argument against theory. Number 2, wealth maximization. Here, ultimate thing, we have to maximize shareholders' wealth. It is a hard-earned money of a shareholder. 20 years they earned this money. They're going to invest in a company shares. Correct? No. Upper you have to protect the shareholders. That is very, very important. So individual stockholder can use the wealth to maximize his individual utility. That's true. Suppose I'm going to invest in Reliance shares now, 100 rupees per share. Maybe after 15 years, it's going to be 3,000 rupees or 4,000 rupees or 10,000 rupees. I'm automatically 40 times return. Correct? No. I'm getting a more utility for the investment. That's it. So wealth maximization is going to be single substitute for a stockholder's utility. Wealth maximization is going to be single substitute for a stockholder's utility. That's it. A stockholder's wealth is shown by the stockholder's wealth is going to be number of shares owned into current stock price per share. That's it. Number of shares owned into current stock price per share. That is going to be stockholder's wealth. That's it. How many shares you're owning? Please check it out. What is the current stock price per share? That's it. It is going to be stockholders' wealth. Number of, so for example, current stock price per share is equal to 50 rupees. I am having 100 shares there. 100 into 50, that is equal to 5,000. What is stockholders' wealth now? 5,000. What is present prevailing market share price? 50. How many shares you are having? 100. 100 into 50, 5,000. That's it. Okay, right. Suppose stock price per share higher, stockholders wealth higher. That's true. And the price higher, wealth also higher. Wealth of the shareholder also higher. That's it. That's it. Suppose investing today 50, after 10 years, going to be 5,000 rupees, 100 times return. That's it. Okay, right. Similarly, maximum utility, maximum stockholders wealth, maximum stock price per share. They are all maximum utility I'm getting. Wealth only derives utility, correct? No. If you have a wealth, it is going to derive utility. So maximum utility I'm getting because of wealth has been maximum because the price per share is maximum. That's it. It's called wealth maximization. There are some people in favor of wealth maximization theory, arguments in favor of wealth maximization. Due to wealth maximization, short-term money lenders get the payments in time. Correct. So there are a lot of people, they invest it, but they get back the money immediately. Correct? No, because of wealth maximization. So money lenders get the payments at time means that company is going to be good company. Good company. So they are not going for any default or the principal and interest. Similarly, long-term lenders, they get a fixed rate of interest on the investment. That's true. Long-term lenders, see, after 10 years, I can get back the loan from you. Long-term lenders, they're getting the interest properly. Short-term lenders, they're getting the money back immediately in the payments in time. Long-term lenders, they can get the fixed rate of interest in time. That's it. Here also, employee shares and wealth also get increased. That's it. Employee share and wealth also get increased. That's called ESOP. Company normally providing ESOP to the company shareholders. What is ESOP? Employee stock option purchase. Employee stock option purchase. So far, till yesterday, you are an employee. Now you are an owner, shareholder. So company offering employee shares, employee stock option purchase came to the shareholders. That's it. To meet, once they meet certain target, automatically company ready to offer some shares. So automatically the employee become owners. It's called ESOP. ESOP. Once the company is ESOP given, automatically wealth also get increased. That's it. ESOP, okay, today I'm just giving 100 shares to my employee. Automatically his wealth is going to be increased. Similarly, I can put the economical and efficient use of the funds. So these are the important theory of wealth maximization. There are arguments against wealth maximization. Here, socially undesirable, not at all required. See, society means rich become richer, poor become poorer. Our wealth will be delivered only to the particular people, not for all people. But this is undesirable. No, social injustice is happening. Rich become richer, poor become paper. Rich people only always get the money, not the poor people. For social unjustification, undesirable. It is not a descriptive idea. There are some people, they are not interested in this idea, wealth maximization. Stockholders wealth maximization does not lead to firm's wealth maximization. That is, both are different. Stockholder wealth maximization is different. Once the stockholder wealth is maximized, it means company's wealth is increased. No, not at all. Not at all. Stockholders wealth will be different. Company's wealth will be different. Stockholders wealth increased. By the way, company's wealth also going to be increased? No, not at all. Not at all. That is not realism. Wealth maximization is endangered when the ownership and management are separated. That's it. Wealth maximization is always endangered, which means we have a doubt. Endangered means we have a doubt. So tomorrow what happens? Owners are ownership management are differentiated. Your money will be in danger. Hard-earned money of the shareholders can be vanishing in a day. Above, automatically, management, there are 3 points. It's a triangle, 3 points in a triangle. Number 1 point, directors of the company. Number 2, shareholders, owners. Number 3, day-to-day running by the management. That's it. Automatically, here your wealth maximization will be endangered because your ownership and the management are separated. Next. So this is the argument against wealth maximization. That's it. 2000 paper. The information is given a fresh perspective on the role of finance management and the finance manager. Now, the role of chief financial officer in the company changes from a controller to a facilitator. That's true. Very, very important. Huge role the CFO is going to play in the modern management. That's it. CFO. Earlier, they are called controller. Now they're going to be facilitator. They're going to facilitate everything. That's it. Without CFO, company cannot able to thrive and strive. That's it. Because the company going to thrive and strive, we need CFO. That's it. What are the emergent role, especially by the speaker, by the author, or is going to be what is the role of CFO in the modern management? That's it. It is true. The modern information age, fresh perspective is given, especially the finance management, the role of finance management, and the role of finance manager also. The job of financial manager in India and today become more important, complex, very complex, demanding nature. A CFO is always a tired person. Without CFO, company cannot able to run. The board always asking CFO, bring CFO. He has to get a suggestion from the CFO. Then only the company can able to decide it. About the CFO role is very, very important, complex and demanding nature. Because of global competition, the job is more complex. Always everyday technology developed, the job is more complex. Financial price is always volatile. Today price, tomorrow another price, day after tomorrow another price is always volatile. Economic uncertainty. Because of global war, what happened? Your company profile will be dooming or booming. Nobody can able to predict tomorrow. Uncertainty. Tax laws are always changing, ever dynamics. So today's law, tomorrow it's going to be wasted. Okay, but there is a dynamic law changes. So old laws has been no longer usable, redundant. Now because GST has been emerging out, so a lot of changes nowadays. Okay, right. Automatically more demandable nature for the CFOs and complex nature also. So they have to face everything. Fine. So global competition, they have to face technology development, volatile finance prices, uncertainty, law changes. Similarly, what are the key challenges before a finance manager? What are the key challenges for a finance manager? Especially, he has to think about investment planning. So the challenge number one, he has to face investment planning, whether to invest or not invest. Similarly, best corporate governance practices you have to do. Because a lot of frauds are happening in the company internal management. As a CFO, you have to report everything. You have to comply with the rules and regulations. Okay, because internal control weak means there are a lot of frauds is going to happen in your company. But corporate governance is one of the important things. Number three, risk management. So the challenge before finance manager, investment planning, corporate governance, and risk management. Similarly, he has to think about financial structure of the company, financial structure. Okay. Similarly, where the funds going to be raised, how the funds going to be raised in debt or equity or preference share capital. Working capital management, one of the important area. Performance management, M&A, especially merger acquisition. Vodafone Idea become B nowadays. Here the role of CFO is very, very important, especially M&A, it's the merger and acquisition. In merger and acquisition, the CFO role is very, very important, especially restructure the company's affairs, investor relations. So these are the areas the CFO is going to be focused. That's it. Next one. So the question has been asked today, same question. See, there are 5, 6, 7, 6 times they've been asked. What is the role of Chief Financial Officer? Responsibility, role, responsibility. That's it. In modern role, what is the role of CFO? What is the role of CFO? That's it. The finance manager now occupies a very important position in the organizing structure. Number one, not only is going to confine his job to raising funds, right? Okay, now his job is multi-dimensional. Earlier, as a finance manager, you have to focus only on how to raise the funds. Now your job is not only raising funds, other things also will be taken into account. It means always they will ask finance manager only these kind of questions. So financial requirement, he has to forecast. He has to best estimator. He has to forecast. What is the financial requirement of the company? Short term and long term. Short term, how much required, where we have to invest. Long term, how much required, where we have to invest. But as a finance manager, he has to be very strong in the estimation and forecasting. The financial requirement of the company, especially for short term and the long term. He has to forecast. He has to estimate. He has to predict how much required, what requirement, when is the requirement. That's it. Number one, forecasting the financial requirement. Number two, planning. A finance manager, so he has to plan out how the funds are going to be procured, how the funds are going to be procured, how the funds are going to be allocated, how effectively the funds are going to be allocated. Number two, planning. That's important parameter. That is important function of finance manager. Number three, procurement of fund. Okay, how the funds to be procured. Best source of finance from a large number of options available for the finance manager. The best decision he has to take. It is going to be influenced by the need, purpose, object, and the cost involved. It is always going to be need. Purpose, object, and the cost involved. Procurement of funds. Number four, investment, allocation of funds. A finance manager has to invest or allocate funds in the best possible ways. He has to invest and allocate funds in the best possible ways. Correct? No? So, finance manager, he cannot but ignore the principles of safety, profitability, and liquidity. He has to ignore the principles of safety, profitability, and liquidity. That's it. Okay. He cannot. In doing so, okay, finance manager invest, allocate in the best possible ways. Right? So, he has to ensure the funds has to be safe. He has to ensure the funds has to generate profitability. He has to ensure anytime funds can be returned back, liquidity. That's it. Okay. So normally these are the things happening. The finance manager going for the best possible ways, always ignore these principles. but he has to take these principles also taken into account. The investing things, can you forget safety of the principal amount? Can you forget about the profitability? Can you forget liquidity? So that is also taken into account. Right. Next, maintain proper liquidity. That is very important for the finance manager. Liquidity, right? He has to maintain proper liquidity to the company because anytime cash requirement. So he has to determine need for liquid assets. And similarly, he has to arrange them in such a way, no scarcity of funds. That's it. If always you have to target upon on liquid assets, how the funds are going to be arranged. How the funds are going to be arranged. No scarcity. Nowadays, funds are always available. One of the important parameters, liquidity. Can you convert? Can it is available right now in terms of cash? You have to ensure no scarcity of funds, but liquidity factor you have to take into account. Similarly, the finance manager, he has to manage the cash in an efficient way. Efficient way, he has to manage cash. That's it. Which means there is a scarcity. Neither there is a scarcity nor remains idle. Not remains idle. It has to earn some return. That's it. But effectively, you have to manage your cash. Ultimately, it has to earn some returns. That's it. So these are the rules the finance manager is going to play in the modern area. That's it. In the modern period, these are the areas he has to focus on. So forecasting financial requirement, planning, funds to be procured, investment of funds, liquidity has to maintain, and cash management. Number 7, dividend. A finance manager know whether declare dividend now or later. He has to think. Suppose once the dividends are declared, it has to be paid to the shareholders. Similarly, how much dividend we have to pay to the shareholders? How much the company can able to return it? How much dividend can be paid? How much company can able to retain it? The finance manager has to think. Dividend. Next, evaluation of financial performance. The finance manager has to implement a system of financial control. He has to implement a system of financial control. He has to evaluate the financial performance of various units. And you have to take corrective measures whenever needed. Wherever needed, he has to take corrective actions. The finance manager has to implement a system of financial control. He has to think about it. Correct? No. Similarly, various financial performance he has to think. Whether the funds are going to generate this kind of income or not, he has to think over it. Then take correct action. Corrective action you can take. That's it. Correct and corrective action you have to take. So financial performance of the funds has to be always you have to think about it. And finally, financial negotiation. That's it. See, you always talk to your bankers, public depositors, banks, financial state. You talk, negotiate, get the funds, procure the funds at a cheaper rate. In a meticulous way, plan and proper, get the funds from the bank, the funds from the depositors, funds from the institution. That's it. Similarly, ensure proper use of surplus. Please ensure proper use of surplus. The finance manager see proper use of surplus funds. The funds are available, surplus available. He has to take necessary for expansion and diversification plan also. Right? About the funds are available in surplus. Can you use the funds for expansion or can you use the funds for diversification? Always protect the interest of shareholders. Funds are available. Don't be lethargic. Invest the funds in such a way whether it can be used for diversification or expansion. That's it. It's very important. Okay. So what are any 4 areas? The future of sole CFO. Just only we have seen the same question has been regulated, but future. Same question. Okay, right. Here the question is future role, not now, future role. In future, what are the role the finance manager can able to face? What are the emerging areas he can able to focus on it? What are the emerging issues going to affect the role of chief CFO? That's it. Number 1, regulation. Regulatory requirements are increasing nowadays. It's going to be regulation requirements are increasing. So CFOs have an increasingly personal stake in regulatory adherence. That's it. So regulatory means a lot of government interference nowadays. Each and every time you have to follow the regulations issued by the government time to time. In this case, as a CFO, you have to be very watchful, very careful. Don't have any negligence. Automatically, if there is any negligence showed, automatically you're liable for prosecution also. Correct? No. Above increasingly, your personal interest also there. Your life is at stake. You're not following the regulation. Automatically, you'll be penalized. In extreme cases, you'll be put into jail also. Your personal stake is at risk. Okay, that's very, very important. Regulatory area, you have to focus on it. Number 2, globalization. Every company now we have a large role to play in globalization. The challenge of globalization means the future finance leaders always work effectively on the global stage. They have to embrace diversity, multicultural. So they not only work for India, they have to work for global. That's it. So CFO is a global CF, global citizen. That's it. Technology, you have to adapt always. CFO generally not a tech guy, but he has to accept technique. Your latest tools, data science, technology, artificial intelligence, AI, machine learning. Okay, so data analytics, business analytics, these are the latest tools available. Our CFO has to learn the technology also. Once you learn the technology, automatically your knowledge will be upgraded. Fast forward, you can do everything. That's it. At least you will be 5 years ahead of your competitors. That's it. Apo technology evolving very quickly. So CFO has to recognize, and you have to drive the business through big data. I told you, big data available. Big data going to capture everything. For big data specialist, you have to learn big data. CFO has to learn big data. He has to learn the business analytics. You must know the advanced Excel sheets. Okay, right. Technology has to be updated. Number 4, risk. Nature of the risk that the organization faces is called changing, requiring more efficient risk management approaches. That's it. Increasingly, the CFO have a role to play in appropriate corporate ethos. That's it. Risk. Risk is always there. Right now, right. So the more effective risk management means CFO have a role to play. That's it. Risk, financial risk, business risk, right. Transformation. Nowadays, so they have to do better service to the customers at zero cost. Nowadays, more pressure on the CFOs for organization to drive better service to the customers at a zero cost. That's it. Stakeholder management. What is stakeholder management? Nowadays, shareholder is very important for every organization. Correct? No. Increasingly. So as a relationship will become important for CFO also. The corporate brand, CFO is in the front line. So always his face is to be known to the shareholders. That's it. Always stakeholder management is very important. Always put CFO in front of. So they are trying to maintain some good relation between CFO and the shareholders. Okay, right. The corporate, who is the face of corporate? CFO only. A good CFO for the company, good image for the company. That's it. Strategy. Especially, there's a lot of role the CFO can play, especially strategy validation and execution. What is a good strategy? We have to choose. How to execute it. That's it. Nowadays, environment is more complex environment nowadays. The challenging also. All CFOs require analytical skills required. CFO required what requirement? He need analytical skills. That's it. He has to be analyst. What is right? What is wrong? When to apply? What to apply? How much to apply? That's it. What not to apply? That's it. Reporting also is going to broaden and continue to burden some the CFO. That's it. It is going to definitely broaden and continue to burden CFO. Reporting, because a lot of reporting the finance manager has to generate. Finance report, the CFO has to generate. Burdensome, cumbersome. At the same time, his accountability factor will be established for CFO. Talent. CFO is always brighter. CFO is always a brighter personality. He is always shine on the talent. He is having a capacity. He is having good behavior. He is always fit for the top finance role. So talent, capability is very, very important for the top role. Let's see. Difference between financial management and the financial accounting. What is the prime difference? Financial management, financial accounting. Financial management primary responsibility, especially in decision making. So primary response financial management is going to be especially financial planning, controlling, and decision making. These are 3 important areas: financial decision making, financial planning, controlling, decision making. But in case of financial accountant, the chief focus will be on collecting data and present the data. Collect the data and present the data. What are the key focus of financial accounting? Collect the data and present the data. That's the decision making. Number 1. Number 2, treatment of funds. In financial management, it's always based on cash flows. The revenues are recognized. Cash flow, because you have to generate cash always. Without cash flows, company cannot able to survive. We need cash inflows. You have to maximize your cash flow and minimize your cash outflows. That's the ultimate thing. Maximize your cash inflows. Minimize your cash outflows. So if cash is actually received, you can recognize it. Similarly, when the expenses are recognized, an actual payment, and the payment then cash outflow, and the money received, cash inflow. That's it. Our financial is based on the cash flows. But in financial accounting, it is going to principle accrual of funds. Receivable, we have to enter. Paid, payable, we have to enter. Salary paid, salary payable, accrual. Interest received, interest receivable, accrual. A financial accounting is based on the principle of accrual. Management is based on principle of cash basis. Here we are always using cash basis. When cash paid, taken into account. Cash received will be taken into account. So purely based on cash basis, right? 3 times questions asked, no? Write a short note of bridge financing. Short-term funds, short-term financial needs. Sorry, I need funds only for 2 months. Bridge finance. Short-term financial requirement, you have bridge finance. That's it. What is the meaning of bridge finance? It is a short-term loan taken by a firm, commercial banks, to disperse loans sanctioned by financial institution. That's it. Say, for example, I'm going to dispense certain commitment I have made. For the commitment I have to fulfill, I get some short-term loans. It's called bridge financing. Right? So disperse any loans or disperse any commitment, I need some funds. Can I get the funds to bridge finance too? That's good. Short-term financial requirements will be fulfilled by the bridge financing. That's it. Having a bridge finance, having the money you are having, funds you collected to bridge financing, it can be used for disperse the loans, or any short-term commitment available, you can able to fulfill it. That's it. Why there is a need for bridge finance? So bridge finance means bridging the time gap between the loan and the disbursement. For example, loan sanctioning will take 1 year, but then how can I survive for 1 year? Loan will be sanctioned, but it will take 1 year. Over 1 year, if I want to survive, I have to get the funds through bridge financing route. But then only I can able to fill the gap, bridge the gap. It's called bridge financing. So getting the funds, it will take 1 year. Meantime, how you are going to manage it? Get the bridge finance. So bridging the time gap between the funds available for you and disbursement is called bridge finance. Bridge finance. Okay, right. Here, you have to ensure the delay in the cost of funds cannot overrun the project cost. That's it. So there is a cost always available. For long-term funds, if you're going to get, there is a cost involved. Bridge finance, there is a cost involved. Anyway, cost will not overrun the project cost. That's it. Cost involved in the finance cannot overrun the business project cost. You have to avoid the overruns. That's it. Sometimes the firms can able to approach commercial banks for short-term loans. Okay, right. In Bank of Baroda, there is a scheme called bridge loan available. Automatically, top-rated clients they can get this kind of bridge finance, right? So banks also sometimes extend bridge finance, especially against some securities. Bring the security, I'll give loans. Banks sometimes telling, bring your security, I'll give bridge loans to you. Bring your non-current debentures, I'll give bridge. Bring your ECR. Automatically, external bridge loans against expected presence of non-current debentures. So if you bring some GDR, NCD, non-current debentures, or external commercial borrowings, we are ready to funding you. That's it. Okay, right. Above, this facility is always available for a period of 12 months only, right? So bring NCD, I'll give bridge financing. Bring ECB, external commercial borrowings. So bring JDR as a security. Will provide you funds to you. That's called bridge finance. Generally, the facility not exceeding 12 months, only for short period. Bridge finance only for short-term loan purpose. This is especially why we need bridge finance. You have to bridge the gap between sanctioning the loan and the final disbursement of loan. Sanctioning a loan and disbursement will take 1 year. Meantime, you have to run our company, So can I get a bridge finance? Yes. But in order to meet the gap between the sanctioning loan and the disbursement, we need funds. The funds we can avail through bridge finance too. Similarly, in bridge finance, the loan rate is always available. Interest rate is always higher because short-term, long-term loans are always cheaper. Short-term loans are always higher. So bridge finance loans are always shorter loans. So therefore, they are always higher. Long-term loans are cheaper. Short-term loans are higher. So these loans are usually repaid as and when loans are disbursed. That's it. Okay, very, very important. So once term loans are disbursed, they have to be repaid. I told you, okay, 8 months, I'll give bridge finance to you. Once the long-term loans provided to you, make it sure, then you have to pay back the bridge finance back to me. That's it. So short-term loan I given to you, bridge finance I given to you. After it means you will get a long-term loan. Correct? No. Once the long-term loan has been sanctioned, just get back the money. Just get back to me the money I just given to you. Correct? No. So bridge finance to be repaid once the long-term loan has been sanctioned. Once the long-term loans are disbursed, bridge finance will be repaid. That's a condition. Till your long-term finance to be sanctioned or disbursed, bridge financing will be there. Long-term funds are given to the company. You have to repay the bridge finance. You have to ensure cost of overrun the project will be avoided because of bridge finance. Loans are very useful to implement the projects on time. So once the bridge finance is available, automatically we can able to implement the projects on time. Disadvantage: the rate of interest on such loan is very high. The rate of interest on such loan is always going to be very high nature. That's it. The rate of interest on such loan is very high. That's the main disadvantage. Very high. That's it. I told you, no, short-term loans are always very high interest rate. Long-term loans are always very cheaper interest rate. That's it. Explain the term bluffing back of profits. Bluffing back of profits. What is bluffing back of profits? See, amount available. That is your own profit. Can I get it back? So profit plucking back, which means funds available that can be used for some finance projects. So bluffing back of profit is nothing but inter source of finance. Okay, which means company not distribute all the profit earned, but it is a part of it. That's called bluffing. Retained profit. Simply it is called retained profit. Simply it is called retained profit. Retained profit. That's it. So company does not distribute all the profit earned, but is going to retain it. It is going to reinvest in the business. It is called retained earnings. So bluffing back of profit is nothing but retained earning for the company. That's it. So generally, long-term funds can be provided, but accumulating profit is the company, bluffing them back into the business. That's it. So retained earned money is available always. Last 4 years, company retained the profit. Huge amount available. Can you use it for own purpose? Yes. It can be used for long-term funds also. Retained profit can be used for long-term funds also. Such funds belong to the ordinary shareholders. Increase the net worth of the company. That's it. Such funds always belong to the ordinary shareholders. It is going to increase the net worth of the company. That's it. A publicly limited company, so they can plug back. They can plug back reasonable amount of profit each year for 2 reasons. What is bluffing back? It's nothing but retaining profit. Why the company going for retaining profit? For 2 purposes only. That's it. Number 1, law requires. Company law says the company can be able to retain the profit. Number 2, how the money is going to be used for own expansion plans. Legal requirements. Definitely every company they have to go for retained earnings. Law. Companies with the law. Companies Act says every company they have to retain the profit. Legal requirement. Number 1. Number 2, it can be used for expansion plan also. That's it. Because of the 2 reasons, company always bluffing back the profit or retaining the profit. That's it. Retaining the profit. That's it. 1 is legal requirements complaints. Number 2, expansion plans. That's it. What are the advantages of preference share capital as instrument of raising funds? Company can raise preference share capital. Company can raise equity share capital. Company can issue debentures. Company can able to raise loans. That's it. Purpose here. What is the purpose of preference share capital? It's instrument of raising funds. So preference over the dividend. Whenever the company earns profit, so they can give fixed rate of dividend. PD. 10% preference share capital. 20% preference share capital. In the sense, 10% profit. 20% profit will be given. That's it. So preference shares are shares which changes certain preferential rights over the equity shares. So they have the payment dividend at the fixed rate. Repayment of capital on the winding of company. Okay. So the payment of dividend at the fixed rate. Repayment of capital at the winding of company. So company going for wind up. Whenever the company going for wind up, repayment will be given first to the preference shareholders. Next one, the equity shareholders. So payment dividend at a fixed rate. Number 1, company going for wind up. Repayment capital first to the preference shareholders, then only equity shareholders. That's it. So 2 preferences. Preference dividend first. Whenever the dividend is going to be declared, make up dividend available to the preference shareholders first. Number 2, repayment of capital only the company is going to wind up. So these are the 2 preferences. Advantages. So they are going to provide long-term capital to the company. They are going to provide long-term capital to the company. No dilution of EPS. For long-term capital, they are going to provide no dilution of EPS. So it is going to have a fixed charge. So there is a leveraging advantage. That's true. Fixed charge. Because advantage is always 10% preference dividend, 20%, 15%. So always they have a fixed charge. It can be redeemed after a specific period of time. That's it. Correct now? Fine. Specific period of time. So you try to maintain specific period of time. It does not carry voting rights. No dilution of control. Does not carry any voting rights. That's true. Equity shareholders only having voting rights. Preference shareholders does not having any voting rights. No dilution of control also. Similarly, So once a company issuing preference share capital, the credit worthiness of the company will be always increased. That's it. Whenever the company issuing preference share capital, credit worthiness, which means on time they will pay the PD, on time they can repay it, on time they can able to pay other things also, maybe settle interest. So credit worthiness will be always increased. That's it. So if you have a voting rates, your control will be diluted. No voting rates, no dilution of control. So preference shareholders, they does not have any voting rates, but no dilution of control. Who is having voting rates? Equity holders. They have a voting rates. They can able to dilute the control. That's it. Financing a business through borrowing is cheaper than using debt. I told you, debt will be cheaper. Debt cheaper than equity. Can you justify sometimes? Say debt you have borrowed now 10% interest rate. Equity rate, equity when you have to pay, sir, 15%. Huge profit available. You have to pay to the equity holders dividend 15%, 20%, 15%. That's it. So sometimes debt will be cheaper than equity. Can you elaborate further? Yes. Debt you borrowed, definitely the borrowing amount only. Fixed rate of interest you have to pay. But in case of equity holders, the company has huge profit, of huge dividend you have to pay. That's it. Okay, right. What is it? Can you confirm? Borrowing will be cheaper than equity, right? Equity shares are issued by the company, cannot take advantage of trading on equity. Generally, equity shares are issued by the company. Equity shares are issued by the company, so they cannot take advantage of trading on equity. There is no advantage for them. That's it. Which means they have overcapitalization. Overcapitalization. That's it. Because equity capital share only if you are rising now overcapitalization, but it cannot be redeemed. See, preference shares can be redeemed. Debenture can be redeemed. Equity shares cannot be redeemed. It can be go for buyback only. Of equity share only we are issuing now overcapitalization. It cannot be redeemed. It cannot be redeemed. So better you can go for debt route. During prosperous period, higher profit leading to higher dividend. During prosperous period, higher profit leads to higher dividend to the shareholders. That is 100% true. This is prosperous period. Company going in the right direction, right way, huge sales happening, but the company can earn higher profit. Automatically, they can give higher dividend also to the shareholders. Automatically, it is going to increase the market value of shares. And there is a possibility for speculation also. Anytime it may be happening. Possibility for speculation also, right? Number 4. The cost of equity share is always high, as the shareholders are paid after tax and preference. That is 100% true. 100% true. 100% true. For example, I told you, PAT, you have to be a preference dividend, EBIT minus interest is equal to EBT minus tax, PAT minus PD is equal to earnings. Correct? After interest, after PD, you have to pay earnings. Correct? You have to pay to the equity holders. Automatically, the cost also very huge. So they are paid after tax, after preference shareholders. Already incurred one cost, interest. Already incurred another cost, PD. After that, huge cost involved for earnings. They have to pay. So already cost involved, interest, cost involved, PD. So then only you are going to pay to the equity holders. Correct? No? The cost of equity share is going to be high. Cost of equity share is going to be high. Cost of equity share is going to be high. Shareholders are paid after tax and preference shareholder. That's it. We are going to pay it after tax and preference shareholder. That's very, very important. Let's see. Distinguish between preference shares and debentures. Preference shares and debentures. What is the difference between preference share and debenture? Preference shares, they have a right to require money prior to equity holders. That is 100% true. So they have a dividend to be given priority before equity shareholders. Similarly, the company going for wind up. So preference shareholders capital will be repaid, will be returned back first, then only equity shareholders capital. That's it. So they have a preference over the dividend and the repayment of capital. That's the main priority. Shareholders are not owners of the company. 100% true. They are not real owners. Right? Certain percent dividend will be given preference shareholders on shares. That's it. That's true. 10% preference dividend, 10% preference share capital, 15% preference share capital. So preference dividend will be given. Number 1. Number 2. In case of debentures, debenture means company borrowed loans. Company issued debenture means company borrowing loans. But there is a liability created for the company. Fixed rate of interest, the debenture holders will always get it. Debenture can be redeemed. So they have prior right to receive the funds also. Anytime, debenture also fixed time available for redemption also. 10 years redemption, 15 years redemption available. Okay, right. Similarly, when the company going for liquidation, wind up, debenture holders will be repaid first, then only preference shareholders, then only equity shareholders. Suppose the company going for liquidation, wind up. So debenture money, secured debenture or unsecured, whatever may be. Anyway, debenture holders will be repaid first, their money. Number 2, preference shareholders' money will be repaid next. Number 3, you have to repayment to equity holders. That's it. What will be masala bonds? Masala bonds. Masala means in Indian context, spices, spices, pepper. Okay, just like this, spices. Okay, jeera, spices. So spice bond or masala bond is Indian name. It is used for rupee denominated bonds. Indian borrowers can sell to investors in overseas market, which means Indian companies borrowing money from abroad in rupee bonds. The bond is not in terms of dollars, rupee. So I want money in terms of rupee. That's the rupee bonds. Of Indian corporates raising money through abroad investors through rupee denominated bond. It is called masala bond. Suppose Infosys company raising masala bond from American investors, which means Indian company raising money from American investors through rupee bond. That's called masala bond. So these bonds are always issued outside India in Indian rupees. Indian rupees. For example, in 2016, National Thermal Power Corporation of India, Thermal Power Corporation, power manufacturer, NTPC, they raised 2,000 crores via masala bonds for CAPEX program, capital expenditure, CAPEX, CAPEX, CAPEX. For CAPEX program, capital expenditure program, they raised 2,000 crores in 2016. Okay, masala bonds. What is masala bonds? Indian corporates going abroad, raising funds in rupee denominated funds, rupee denominated bonds, rupee denominated. I need money in rupees, not in dollars. Sorry, sir, $20 million. No. I need in terms of crore rupees. Of Indian investor raising money abroad in Indian rupee bonds, it is called masala bond, a spice bond, spice bond. Okay, let's see 21 paper. Explain briefly the callable bonds and puttable bonds. Option, right to buy or right to sell is called option. Rights has been given, either you can buy, it's an obligation to buy, but not compulsory to buy, it's called option. Callable bonds means it's a call option given, gives the issuer right to redeem the bond before maturity at a predetermined price known as call price. That's it. Apo, before maturity, you can redeem the share. Rights has been given before maturity. So bond can be redeemed, bond can be repayable. Rights given to you. It's a right, not it's an obligation. Either you can redeem or not to redeem. The predetermined price, called callable bonds, gives the issuer the right to redeem, not a compulsory right to redeem before maturity, predetermined price. This is the price we are going to pay. This is the price we are going to pay. That's it. So before maturity, the bond can be repaid, redeemed at a predetermined price. It's called callable bonds. In case of puttable bonds, puttable, which means it gives the investor a put option, right to sell the bonds, right to buy call, right to sell put. That's a definition in share market. So before maturity, we have a right to sell the bonds before maturity. So before maturity, right to buy the bonds, right to redeem, Okay. So right to redeem the bond before maturity means call price. That's it. Right to redeem the bond before maturity, or right to sell the bond, puttable bonds. That's it. So these are two things. It's called callable and put. Call option means in option trading, right to buy. Put option means right to sell. Put option means right to sell. That's it. Right to sell. Right. So put option means right to sell. Call option means right to buy. So puttable bonds means investor an option, right to sell the bond back to the company before maturity. That's it. The investor have a put option. Investor have a right. Anytime the investor can sell the bond back to the company before maturity. That's called puttable. That's it. In callable option, give the issuer, the company. Callable bonds gives the option to the company. Anytime the company can able to redeem the bond before maturity, predetermined price to the issuer. Rights given to the issuer. Anytime they can able to redeem the bond before maturity. So puttable bonds, right given to the investor. Anytime he can right to sell the security before maturity, back to the company. But puttable bonds give the option to the share investor. Callable bonds give the option to the issuer company. That's the difference. That's it. Let's see Venture capital financing, that is also one of the important questions in the examination point of view, VCF. What is venture capital financing? See, any risky venture going to be financed or promoted by the qualified entrepreneurs who lack experience and funds to give shape to the ideas. That's it. I am an entrepreneur. I have idea. I am an entrepreneur. I have idea. But I'm lacking experience. I'm lacking funds. If somebody helping me, so I can come out with a good prospect. I can come out with a I can come out with a good product. That's it. Venture capital association described venture capital means risk finance for entrepreneurial growth oriented companies. Suppose he has been started as a company, entrepreneur. He needs funds, but he's having idea, he needs funds, lack of experience. Can I support him through funds? It is for risky financing. I'm going to provide to him. It is called venture capital. Venture capital. That's it. It is investment for the medium and long term. Okay, I'm ready to fund you. You need funds? No. Okay, you have idea. You register a company, you have idea, but lack of experience, you need funds. I'm ready to provide to you. Correct? No? Right. So I am ready to provide to you for a medium and a long term. Medium and a long term. That's it. To maximize the return. Right. In a broad sense, venture capital financing means venture capitalist makes investment to purchase debt or in equity from inexperienced entrepreneurs. That's it. Okay. Either you can make investment to purchase the debt, you can purchase the debt or equity from inexperienced entrepreneurs. That's it. Okay. That is very, very important. Right. So you are inexperienced entrepreneurs, but you need funds. Can I invest for 70% stakeholding in your concern? But you need funds, correct? No, you registered as a company. Can invest 70% funds or 80%? Right. A venture capital means a person who is going to take highly risky ventures with potential for success. There is a tremendous growth is going to be happening, but he needs funds. Can invest a 60% investment, 70% is stake. That's it. So 70% belongs to me, 30% belongs to you. Correct? Can I invest? Right. Either for long term or short term, funds can be invested. Features. Long term investment growth, but it is only for small and new high risky venture. That's it. Long term investment, I'm going to invest. Definitely, it's a small and new highly risky venture. That's it. Small funds only required. 6 crores you read. I'm ready to invest. Okay, but at the same time, risky venture. That's it. It is in the form of equity financing. Okay. Your equity capital, 70% I'm going to provide. So can I give 70% stake? Equity financing. That's it. The venture capitalist going to invest in the entrepreneur, lacking experience, lacking funds for a stakeholding in the equity financing. That's it. Investor also provides support in form of sales strategy, business networking. Correct? No. So he's going to be provide support in form of sales strategy and business networking. That's it. What are methods available? Number 1, equity financing. Number 2, condition loan. Number 3, income note. Number 4, participating debenture. So these are the methods. I can come to you. Can I come to you in equity financing, or can I provide you loan, or can I provide you income note, or can I provide you participating debenture? These are the 4 ways. I'm ready to funding you. These are the 4 ways I can participate in your business. I can participate in your business. So equity financing, condition loan I can give, income note I can give it to you, or participate debenture. That's it. So equity financing, income note, condition loan, participate debenture. That's it. So can you elaborate further? 2020 paper 4 marks. Yes. Venture capital financial always takes from the form of equity, right? I'm ready to fund you long term, but in your equity, I'm going to participate. Number 1. Number 2, income note. It is a type of hybrid financing, which means you have to pay interest to me as well as royalty and sale at a lower rate. I need 2 amounts from you. I need interest from you. You need funds. I'm ready to provide you, but I need from you interest plus royalty on sales. So these 2 things I'm requiring from you. That's the income note. Number 3, condition loan. Here I'm going to pay loan to you. Okay, right. But here you have to pay royalty to me. Royalty. Correct? No. From your sales, can you pay royalty? I am providing you loan. Can you pay royalty? I don't want interest. No interest to be paid on such loans. Okay, that is called condition loan. The condition, I want royalty on your sales. What is a sales? Can you provide me 3% on your sales? I don't want any interest from you. You have to repay me. The repayment of loan will going to take place after 5 years or 7 years. But I need certain percentage on sales. Right. Number 4, participating debenture. That's it. It is a type of financing. Security carrier charges in 3 distinct phases. Number 1, startup phase. No interest is charged. Startup phase, no interest will be charged. First phase, startup phase. Number 2, second phase. Low rate of interest will be charged up to a particular level of operation. That's it. Participants, okay. Initially, startup. How much funds required for startup? Sir, initially I need 1 crore. Okay, I provide you 1 crore. No interest. Second phase, okay, after 6 months, I'm providing you another 3 crores, but low rate of interest. So, okay, after third phase, reach certain height, correct? No, I need high rate of interest. Initially, I'm supporting you, no interest. After a couple of months, I'll provide you some additional amount. Can you provide some low rate of interest? Okay. Third phase, I'm going to give additional support to you in the form of funds. Can you give me some high rate of interest? That's it. So these are the three stages in debenture can be participation. The venture capitalists can be able to participate. So first one, equity financing. Number 2, income route. Number 3, condition loan. Number 4, participating debenture. That's it. Stage by stage, I'm participating. Initially, no interest. Second phase, low rate. Third phase, high rate of interest. That's it. Next one. Same question. Okay, right. Number 1. So generally, they'll be always involved in the risky projects only. Correct? No. What is venture capitalizing? Already told you. Okay, same question has been repeated. A person lack experience and funds will be given support or funds. So by the way, to shape their ideas. So they'll be participating to these 4 routes I told you. Okay, equity financing route, income route, condition route, and participating debenture route. That's it. So generally, the features always long-term investment, the growth. So I'm going to invest only a small and risky venture. That's it. It is in the form of equity finance. Generally, the investor is going to provide support in the form of sales. Okay, I'm an investor. I'm going to invest in a company. So I can help you for sales strategy. I can help you for business networking factor. That's it. What are factors to be considered before financing any risky project by the venture capitalists? That's it. What are factors to be considered before financing any risky project? Number 1, technical feasibility of the new product. See, this is actually you are an entrepreneur. You're going to start a venture. You have some idea, correct? No? New product you're going to develop. If technically the product is feasible, I'm going to check it out. So these are the factor a venture capital has to think before investment, before investing in the entrepreneurial journey. Okay. So before you're going to invest in the entrepreneurship, so he has to think over these factors. So technically this product is feasible, he has to think twice, thrice. Second point, that there is a market for the product. Okay, I'm going to invest in a company, the product. Definitely the product have a feature, the product have a market. So I'm going to give a research. Then only I can invest. Number three, my risk in your company is always very high. Correct. Because you're an entrepreneur, first time you're going to start your business, having this idea, the product going to be generated. Correct. But whether it's a feasible, I'm having high risk. So suppose if a company earn future profit, can you compensate the risk? The amount of investment I'm going to invest in a company, the future profit going to compensate me. Number 4. So quality of the management team is very, very important factor to be considered. Who is your management? Who is running day-to-day affairs? That will be taken into consideration. A high level of commitment to the project is required. Can you commit to the highest level? Who is your team? Show me your team so that I can ready to invest. So highest level of commitment from the team is required to complete the project. Number 5, technical ability of the team is also very vital. So they have to develop and produce a new product. That's true. So technical ability. I have to think about the management team. I have to think about the technical feasibility also. Technically, this product is feasible. This service is feasible. It is having a market. Viability is there. It is going to earn profit. All the parameters going to be checked before I can invest in your company. That's it. So these are the factors a venture capitalists always have to think before he can invest in the new company. That's it. So his name is the venture capitalist. That's it. Let's see. What do you mean debt securitization? Explain the basic debt securitization process. Number 1. Number 2, write a short note on debt securitization. Number 3, concept of debt securitization. All are same. All are advantages, everything same. That's it. What is debt securitization? It is a method of recycling of funds. Funds has to be recycled. That's it. It's a process. Loans and other receivables are underwritten and sold in the form of asset. Okay, loans for the company. Okay, don't worry, I'm ready to take care of you. That's it. One person says, you have a loan, don't worry. If you have receivables, don't worry, we underwrite and sold in the form of asset. Your loans and your receivables are underwritten and sold in the form of assets. It is a process of transferring the assets of a lending institution into negative instrument for generation of funds. Automatically, lending institution, bankers, lending institution. Okay, so they provided loan. So those loans are underwritten and sold in the form of asset. Automatically in the form of a negotiable instrument, transfer document. Those loans will be converted into assets. Those assets are sold. Those assets are going to be transferred in the form of negotiable instruments for generation of funds. Okay, right. Automatically, I am having, okay, this is to be transferred, right? Apo, transferring the assets into negotiable instruments for generation of funds. Very, very important. So only loan carries only interest. Suppose the loan has been converted into asset. The asset will be converted into negotiable instrument. It is going to generate revenue. That's the latest idea. Loan will be converted into asset will be converted into negotiable instrument. The negotiable instrument is going to generate funds. Okay, right. What is the process of debt securitization? Debt securitization means the loans are segregated into relatively homogeneous pools. Homogeneous pools, which means some common type of loans will be put together under homogeneous pools. That's it. The loans are segregated and put into relatively homogeneous pools. Number one. Number two, the basis of pool is type of credit the company can give it to you. Maturity pattern, interest rate, risk. So type of credit, maturity pattern, interest rate, and risk. Okay, right. So based on these factors only, we'll be pooling together. Number three, the asset pools are then transferred to trustee. Number three. Number four, the trustee then issues security which are purchased by investor. The trustee then issues securities which are purchased by investor. That's it. Okay. The trustee issues securities which are purchased by investor. Right. Who is a custodian of those instruments? A trustee. Debt securitization have a trustee who is controlling those assets. Okay. He issuing the security which are purchased by the investor. Okay. Our loans are convertible into assets. Assets are retransferred into negotiable instrument. It is under the custody of trustee. Trustee is going to issue the securities that is going to be purchased by the investor. So such securities or asset pool are sold on undertaking without recourse to the seller. Once sold means sold. It cannot be coming back to me. Which means already loans are sold. Again, same loan cannot be coming back to company. The same loan cannot be coming back to bank. That's it. Once these asset pool sold, it doesn't have any recourse, without recourse to the seller. Very, very important. It cannot come back to seller. I sold it. Cannot come back to me. So banks sold the assets. Bank provide loan to the creditors. So those are assets for the bankers. So there is already sold. It cannot coming back to the seller. That's it. Without recourse. That's it. What are the functions of debt securitization? It is a method of recycling of funds. It is especially beneficial to financial instruments to support the lending volumes. It is method of recycling of funds, especially beneficial to financial intermediaries to support lending volumes. Number one, what are the main processes involved in debt securitization? Origination function, pooling function, securitization. So these are the three functions available. Let's see one by one slowly. Okay. So debt securitization, what are three functions generally? Origination, pooling, securitization. Where it originated? From the banks only. Next, pooling. Third one, securitization. Convertible into assets. Where it originated? Generally in the books of banker only. And whenever the banker or any financial institution or any leasing company or any hire purchase company or any credit card company or any housing finance company, they always lend money. They provide loan to the borrower. Correct? No? That is origination. Where it originated? From the bankers only. From the financial institution only. It just started. This creation of financial asset is called origination function. That's it. Number one, it is called origination function. Number two, pooling function. What is pooling function? Very, very important. These loans or receivables are clubbed together. I told you. Initially, we just providing loans to bankers only. Number two, these loans are clubbed to create underlying pool of assets. These loans by the bankers are pooled together in the form of assets. This pooling is called special purpose vehicle. It is called SPV. Special purpose vehicle. It is called SPV. That's it. So loans are clubbing together to create a pool of assets. And finally, this pooling will be transferred in favor of SPV. What is SPV? Special purpose vehicle. Okay, definitely that SPV will act as a trustee to the investor. Right? Step number one, loan to be provided. Number two, it will be pooled together in the form of assets. Number two, that pooling will be taken by this SPV purpose. That is transit in favor of SPV, special purpose vehicle. That's it. It may be a company or trustee, wherever may be. For those assets are under the custody of trustee. Trustee is called SPV. SPV. So the trustee acting as a trustee, the trustee will be acting on behalf of SPV for the investor purpose. Correct? No? Right. So this pooling of asset is called SPV's portfolio. It's called pooling function. Okay. Automatically, those assets are pooled together in the form of SPV, special purpose vehicle. Who is going to control the SPV? The trustee. Where is going to for on behalf of for whom behalf he is going to act? Behalf of trust investor only. On behalf of investor only is going to act as a trustee. That's it. Automatically, the assets are now moving to the SPV's portfolio. It is managed by the trustee who is going to act on behalf of investor. That's it. It is called pooling function. Pooling function. Number three, latest financial instruments. Number three, securitization function. That's it. Once assets are transferred to SPV, SPV going to issue securities to the investor. It is called pass-through certificates. It's called pass-through certificates. Now assets are pooling together in favor of SPV. It is controlled by a trustee who is going to issue securities. The security name is called pass-through certificate to the investor. The issue of securities is called securitization function. The issue of security is called securitization function. That's it. Here, debts are converted into security. That's it. Debts, loans, converted into security, which is going to be issued by the SPV to the investor. That's it. Now, loans are sold. See the line? Simple layman language. Loans are sold. Bank loans to the customer are sold to investor. Bank loan to the customer are sold to the investor. This concept is called debt securitization. What is the advantage of debt securitization? The asset is shifted off from the balance sheet. Correct? No. From the bank's balance sheet, the asset is shifted off. Correct? No. No more asset. Bank already converted into, bank already sold those assets. It is pooled together in the form of SPV. Correct? No. The trustee going to issue securities to the investor. That's it. Automatically from the bank's balance sheet, those loans are written off. Those loans are to be shifted off. Thus giving the originator recourse to off the balance sheet funding. It is off balance sheet, out of balance sheet. Now those loans given by the banker to the customer off balance sheet. No balance sheet. Earlier, bank loans are asset to the bankers. Correct? No. Now it is off the balance sheet. Number two, convert the liquid assets into liquid portfolio. So they have a liquid asset. Can we convert into liquid portfolio? Number two. That's it. Number three, it facilitates better balance sheet management. So assets are transferred off balance sheet, facilitating satisfaction of capital adequacy norms. That's it. Apo, it is better balance sheet management. Assets are transferred off balance sheet. Automatically it is going to facilitate satisfaction of capital adequacy norms. That's it. Apo, it is going to be off balance sheet item. By the way, all the capital adequacy norms by the banker has been followed. So banks are under the control of RBI. RBI time to time they issue so a lot of notes. Correct? No. Automatically capital adequacy norms are followed. The originators, bankers, credit rating will enhances. So when the banks have a bad loans, the image coming down, the rating coming down. Once the bank loans are sold, automatic credit rating will be enhanced. That's the main advantage. It is going to be enhanced. That's it. That's the main advantage. Debt segregation. That's it. Now let's start with examine the concept of leverage lease. What do you mean leverage lease? That's it. I told you there are two types of lease agreement. Generally, the lease transaction, okay, by leasing company. Either so they can ready to fund it to the lessee in the form of financial lease or operating lease. There are two types of leasing available. Right? What do you mean leverage lease? That's it. A lease agreement partly financed by the lessor through third-party financial institution. That's it. Financed by the lessor through of third-party finance issue. Right? Which means partially financed by the lessor and through third-party financial. Some financial institution also involved for lending purpose. But partly financed by lessor also. Automatically, leverage lease transaction means a leasing company. They are always in the lease only. Okay, leasing. Either financial lease or operating lease, the leasing company. They're going to ready. If you want assets, I'm ready to fund you. I'm ready to, okay, if you want tractor, you need finance for tractor, I'm ready to finance for your tractor. That's it. Leasing company. So they are called equity participants or under lender also. They're called loan participant. Okay. Leasing company means if you want loan, I'm ready to provide to you. If you want vehicle, I'm ready to provide to you. That's it. Upper vehicle financing, that is also lease financing. That's it. I'm ready to jointly fund the investment assets to be leased to the asset. Okay, if you want asset, no issues. I will purchase the asset. I'll give it to you on a lease basis. Can you pay EMI? If you want tractor, okay. If you want tractor, okay. I'll purchase a tractor. I'm a lease company. I purchase a tractor. I'm just going to provide lease to you. Can you pay in 35 installments or 40 installments? Can you just give me 40 EMI? That's it. Apo assets are purchased by the lease finance company. It will be provided to the lessee in the form of rental. It is called lease. It's called lease. That's it. So I am ready to fund the investment. So those assets are going to be leased to the lessee. That's it. Just generally it's called lease meaning. Okay, right. Now, mechanism. In lease agreement, the lessor undertake to finance only a part of the money required to purchase asset. That's it. The major part of finance is arranged the financier, to whom the titles of the asset as well as the release are assigned. That's it. Apo, there are in the lease agreement, lessor 20% I'm ready to finance, 80% from the bank. So the ultimate financier will be the banker. They have a title deeds. So they have a lease details are assigned. That's it. So partly funded by the lessor and majority funding by the third party financier. The third party financier only have a title deeds of the assets. He only all the details for the lease amount, lease rental, everything. He only knows everything. That's it. So they usually there are three parties: lessor, lessee, financier, banker. See, assets, tractor you want, okay, 20% I'm funding for tractor, 80% banker. All the title will go to banker only. You can use a vehicle, tractor. Can you pay rental amount to the banker? That's it. Upper lessor, financier, lessee, three party in the leverage lease. So a lease agreement is between the lessee and the lessor only. That's it. Lease agreement between the lessee and the lessor only. But 80% lease will be taken by the financial institution. 20% only will take care by lessor. That's it. But is supplemented by another separate agreement between the lessor and the financier. Upper lessor and lessee one agreement, lessor and the financier other agreement. So 20% funding by lessor, 80% from the financier. But there are two agreements to be take place. One between the lessor and the lessee, another between the lessor and the financier. That's it. So financier agreed to provide 80% of the money required. For tractor is going to be 15 lakhs. So 12 lakhs is going to be given by financier, banker. Balance 33 lakhs going to be financed by the lessor. But there is agreement between the lessor and the lessee, and there is agreement between the lessor and the financier. Always the lessor will going to agreement only with the lessee, not with the financier with the lessee. Okay, lessor with the lessee one agreement, lessor financier another agreement. So lease agreement enable the lessor to undertake and expand volume of lease business with a limited amount of capital, and it is called leverage leasing. That's it. That's it. Okay. So it is going to undertake and expand volume of lease business with a limited amount of capital. It is called leverage leasing. That's it. Okay. It means lessor undertake expand the lease business. Correct. See, I have a limited capital, 20% only invested, but I want to expand the business. I need the support of 80% financier. I am in the leasing business, but I am a small financier. I have a small amount only. 20% I am ready to fund. 80% from the financier. We both come together to funding the asset. 20% from my side as a lessor. 80% the financier, banker. We ready to fund the assets. So by the way, so we are ready to provide to you. But there are two agreements going to be take place. One between the lessor and the lessee. Another one is going to be the financier and the lessee. That's it. So this kind of leasing is called leverage leasing. Ultimate purpose of lessor, he wants to expand the business with a limited capital. He is not 100% capital, he is having 20% capital. But he wants to expand the leasing business. I know a lot of lessees. They need assets. But I am ready to fund you. But not alone. Not alone by me. But I, along with my financier, be ready to provide the support to you. That's it. So it is called a leverage lease. That's it. Similarly, very important, we are going to study everything in AS 19. Okay, leases. AS 20 earning per share, accounting standard 20 earning per share. AS 19 is going to be leases. So distinguish between operating lease and financial lease. Same question repeated. Operating lease, financial lease, everything. This is purely AS 19 concept, accounting standard 19 concept, leases. First, you have to study thoroughly what is financial lease. The one which is not a financial lease is called operating lease. The one which is not a financial lease is called operating lease. So what is financial lease? In the financial lease, the lease term always lessor is one party, lessee is another party. In financial lease, Lease term is for the major part of economic life of the assets. Lease term for the major part of economic life of the assets. That's it. Major part. For example, asset life is going to be 5 years. 4 years, the lease term. Is a lease term. The asset life is going to be 5 years only, but 4 years the lease term. It's a financial lease. It's a financial lease. What is financial lease? Lease term will be major part of economic life of the asset. Suppose the asset is having a 5 years life, 4 years is a lease. Number one. Number two, risk and rewards transfer. Risk and rewards transfer. That's it. Risk and rewards transfer. Under financial lease, lessor transfer. Substantially all the risk and rewards incidental to the ownership asset to the lessee. That's it. Under the financial lease, substantially all the risk and rewards are transferred. All the risk and rewards are transferred. Okay. Under financial lease, all the risk and rewards are transferred at the end of the lifetime of the lease period. Okay, sir, lease period going to be completed. Do you want asset? I'm ready to transfer it. The lessor said to the lessor told the lessee. Okay, sir, lease term comes to an end today. 5 years over. If you want asset, I'm ready to make a sales to you. Okay, are you ready to buy from me? That's it. It's called risk and rewards transfer. But there is an option on the part of lessee to buy the asset from the lessor. It is a financial lease. 5 years you pay the rental. Now 5 years over. Are you ready to pay the? Are you ready to buy the vehicle from me? Okay, risk and rewards will be transferred. Number three. Always risk lies in the lessee only, because financial lease no. Always risk lies with the lessee only. Even obsolescence also. Even suppose that asset is no longer usable, redundant, technological changes happening, asset become useless. Always the risk of obsolescence always lies with the lessee only. That's it. Next. So continuation of lease periods are certain, reasonably certain. How many years going to continue the lease? 4.5 years, 5 years. I know exactly maximum period the lessee going to continue. In financial lease, generally non-cancelable. Lessee cannot cancel the lease agreement. He cannot cancel unless the contract provides. The contract, lessee has the option to cancel the lease term. Then only the lessee can able to cancel the contract. Otherwise, lessee cannot cancel the contract. It is non-cancelable unless until contract provides the term. Otherwise, lessee cannot cancel financial lease. This financial lease. What is operating lease? The one which is not a financial lease, operating lease. Can I, sir, I want asset only for 5 months. Operating lease. No risk to transfer. Only rental only you are going to pay. Sir, I want asset only for 7 months, sir. Not 7 years, only 7 months, sir. Financially, operating lease. So I want asset for 5 years, sir. Financial lease. So I want asset for 6 months, sir. Operating lease. That's it. Operating lease. The lease term is significant. Less than the life of the asset. Suppose life of the asset is 5 years. Sir, I want asset only for 3 months, sir. 4 months, sir. Operating lease. The one which is not a financial lease is called operating lease. Financial lease, maximum period. The lessee going to use asset. Lifetime of the asset. The operating lease, few months are going to use. Suppose lifetime is going to 5 years, you're going to use only 3 months or 4 months. Under operating lease, the lessor does not transfer substantially all the risk and rewards. He is not going to transfer all the risk and rewards incident to the ownership of the assets to the lessee. That's it. The operating lease, risk and reward not to be transferred. Risk and reward not to be transferred to the lessee. That's operating lease. No. Only 5 months. Where is the risk transfer? No risk. Financially, risk will be transferred end of the period. Here, no risk will be transferred to the lessee. That's it. Here, risk of obsolescence not falls on the lessee, only with the lessor. Because 3 months only lessee using the asset. Balance period is lies with the lessor only. All the risk of obsolescence with the lessor only. Continued lease is not reasonably certain. That's it. Okay. Here, you have to continue the lease reasonably certain. Correct? No? Here, no certainty. Whether to continue or not continue. 3 months only required. Can you extend? Yes, you can extend. Can you cancel? Yes, you can cancel. In operating lease, anytime you can cancel it. Operating leases are generally cancelable unless contract provides otherwise. That's it. Operating leases are generally cancelable. Always cancelable. Anytime you can able to cancel. But here you cannot cancel the lease. But here you can able to cancel the lease. That's it. 5 months only I'm using. No. After 6 months, I can cancel it. So you can generally you can cancel it. That's it. Generally you can cancel it. But non-cancelable. Generally you can cancel it. That's it. Let's see. 15 paper. Sell from lease back. Sell from lease back. Under this, what is sale? See, I want to sell my machine. Okay, no problem. Sell your machine. Same time, I want machine also. Then get the lease. get it on lease. That's it. I want cash, make a sale. I want machine, get it back on the lease term. That's it. It's called sale come lease back. Okay. So owner of the asset, he wants to sell the asset to the buyer, correct? But because he wants money, he's going to sell the asset. Same time, he wants asset also. Then he's going to lease back from the same asset from the owner also for rentals. That's it. Okay. I'm ready to sell my assets for certain amount, correct? Because I want money. Same time, I want mission also. The same person is sold on the buyer. The same person, now the buyer become owner. I'm asking the owner, sir, can you give me rental, the same assets, can you give me on rental basis? Yes. This is called sale come lease back. Sale come lease back. So under this agreement, asset is not physically exchanged, only record purpose. The machine is with me only. It's sold, coming back in the form of lease back. Sale come lease back. Asset is with me only. Transaction wise, it was sold. That's it. Same time, coming back on lease basis. But asset is with me only. Correct. The same asset sold, same asset coming back. But it remains with me only now. But transaction wise, it was sold and lease back. But physical point of view, existence of the asset is always with me. That's it. Not physically exchanged, it always in records only. So the main advantage of the method, lessee can satisfy himself. That's true. Because he has to satisfy himself. The quality of asset is very, very important. The quality is very, very important. Okay, right. That's it. So automatically, after the possession of the asset, convert the sale into lease agreement. Once once the goods has been, once asset has been sold, automatically lease agreement to be created. So it is called lease back. It's called lease back. That's it. What is operating lease? I told you already. Okay, right. What are advantage of leasing? Leasing. That's it. 2018 paper. Right. Leasing. Leasing gives you flexibility. Why you have to buy the machine? It is 2 crores, 3 crores. Instead of this, can you pay some rental every month, 5 lakhs, 50,000 or 1 lakh? But anyway, you want machine only for 1 year. No. Why you have to buy the machine? Can you go for leasing? Flexibility. That's it. Same thing. Leasing company can make finance 100% cost of equipment. Leasing is a time saving. Documentation will be quick. Immediately, leasing can happen. Suppose in case of operating lease, safeguard lessee against subsidies. I already told you. So operating lease means I'm going to use asset only for 5 months or 6 months period. Upon the obsolescence loss will always lie with the lessor only, not with the lessee. Leasing does not affect the borrowing capacity of the lessee. Leasing in no way not going to affect the borrowing capacity of the lessee. That's it. It is not going to be affected, right? So because of lease, my borrowing capacity of the bank is going to be restricted? No, not at all. It is not going to affect your image. Next one. Leasing equipment is on off the balance sheet asset. It's always an off the balance sheet asset. It is being economically used by the lessee and does not affect the debt portion of the lessee. That's it. So automatically it is off the balance sheet asset. It is going to be being economically used by the lessee, not going to be affected by the debt portion of the lessee. That's it. Next one. Sale come lease back is arrangement. It is helping the lessee overcome the financial crisis immediately. That's it. So once you have a sale come lease back, automatically the financial crisis of the lessee immediately can be arranged. That's true. I sold, correct. I have a cash now, correct now. Then I become lessee, correct now. Initially, I'm the lessor. I sold the machine. The seller sold the machine to the buyer. The buyer become year after lessor. I'm going to get it back the machine again on lease. So my name is lessee. So lessee having a financial debt is almost solved. Reason because the machine sold is having cash. The financial crisis is almost solved. That's it. Leasing is a convenient for small equipments. The debt financing is impractical. That's true. Any small equipment, if you're going to use it now, why should have to buy? Goes for the rental. That's it. So tax benefits also sometimes accrue to the lessee depending on the tax status. That's it. So always tax benefits always sometimes it is going to accrue. The tax benefits are always going to accrue to the lessee depending upon the status. Okay. It is always also, tax benefits may also sometimes accrue to the lessee because of tax status. That's true. So lessee having a tax loss savings. Okay, right. So because tax status, any loss arising to lessee, tax benefit is having. That's it. So these are advantages of leasing. That's it. So what are the limitations of leasing? Number 1, minus points of leasing. The lease rentals are payable soon after the acquisition of assets. 100% true. That's true. Once assets are acquired, rental become norms. Correct? No, you have to pay the rental. So generally, sir, any question period? Sorry, no moratorium period is allowable. That's it. So generally, term loans are given. Term loans are given. So 30 EMIs, 40 EMIs are given. Sorry, no question period, no moratorium period. The lease arrangements not be suitable for setting up of new projects. It is not viable for new projects. Okay, because it entails cash outflows even before the project comes to operation. For new projects, already a lot of cash outflows. So it is not viable for the new projects. Leasing not viable for the new projects. Existing projects only leasing is viable. The lease assets are purchased by the lessor. Correct. Who is the owner of the equipment? 100% true. Who is going to purchase assets? The lessor. The seller's warranty for satisfactory operation of lease assets. It is not to be available for the lessee. That's it. Sometimes seller can give warranty also for satisfactory operation of the lease assets. Okay, right. But seller warranty may not be available to the lessee because assets are purchased by the lessor. Seller warranty not to be given to the lessee. It is always lies with the lessor only because he is the owner. He is having a warranty period for the sales. So assets are purchased, he is having a warranty. That's it. Lessor generally obtains credit facilities from banks to purchase the leased equipment. 100% true. That's true. So I need a machine. Correct? No. The machine can be given to the rental purpose. For machine, I need funds. No. I can get it from the banks. So funds, I can get it from the banks. I purchase assets. Now the assets are going for rental basis. That's it. Similarly, from the banks, I got a funding. Immediately, I purchase the leased equipment. Now the equipments are hypothecation also. Correct. Once assets are funded by the banks, it is hypothecated to banks. In case default happening on the part of lessor to the banker, so banker we repossess those assets, right? In favor of the bank. So they are always hypothecation only. Lessor want assets going to be funded by the bankers. It is called hypothecation. In case lessor default, lease equipment rentals, automatically it will be taken back by the bankers. Default in payment by the lessor. Lessor will have a default in the payment. Correct. This what happened? All the assets of lessor seized by the banks. Automatically, it is a loss to the assessee. He is not going to get hereafter rental from the lessee. Lessor equipments are going to be forfeited by going to be taken back by the bankers. It is a loss for the lessor. Hereafter, he won't get any rental payments from the lessee because no machinery available. So lease financing has a very high cost of interest. 100% true. Very high cost of interest. That's true. Because once we are going for lease now, it's a high cost of interest. Compared to in term loans, that's true. Our lease financing always high cost than the term loans. Term loans are cheaper, lease financing will be higher. Suppose term loans are 8% interest, lease financing 18% interest. The lease financing always having high cost of interest. That's it. Even the loans are given to financial institution for lease financing. So if you want term loans, you have 8% interest. For lease financing, 18% interest. So lease financing always having high cost of interest. That's it. Okay, right. These are the limitation of leasing. Right, to the 18th paper. What are source of short-term financial equipment of a company? Any short-term financial equipment where the company can going to get very simple. Number one, I can straight away go to my supplier. I'm going to go to the supplier, sir. Can you give me 1 month credit for the material you're going to supply to me? My supplier, I'm asking my supplier, sir, can you give me 1 month credit so that I can make a sale, so I can get a revenue, I can repay to you. Supplier credit also one of the short-term financial equipments. So can you? I'm asking my supplier, sir, can you give me 2 months credit? That's one of the short-term expenses of a company. Number two, accrued expenses and deferred income. Outstanding expenses. So can you pay 1 month after? Deferred income. So these are the number two financial credits. Number three, I get a short-term loans for working capital purpose from the bankers. I can get a short-term loans for working purpose from the bankers. Number four, fixed deposit for 1 year or less. Fixed deposit for a bit of 1 year or less. Okay, I'm going to get fixed deposit. Okay, that should be repaid after within 1 year, within period. So I can accept fixed deposit I can accept fixed deposit that should be repayable within 1 year. So that is also short-term funding. I can get fixed deposit. I can use it for the project. Short-term financing. Sometimes I can get money from the customers as advance. I'm asking, can you pay some advance money? So I can use it. Short-term fund, short-term financing. Above credit from the supplier, advance from the customers are called short-term funding. Short-term financial requirements for the company can be fulfilled. Any short-term provisions also the company can be able to create. So these are the ways the short-term financial requirement of the company can be fulfilled. That's it. Next, same thing we're going to elaborate on. Can you describe any four sources of short-term finance? Number one, trade credit. I can ask my supplier. Sir, can you give me credit for 15 to 90 days, 15 days, half a month to 3 months time? Huge credit. So by the way, I can generate business for my company. By the way, my operation will be started. By the way, I can open account. By the way, bills payable started. By the way, I can get a credit also. That's it. So by the way, I have money available. It can use for rotation purpose also. By the way, business also going concern. Because of trade credit, my business will run. Correct? No. Because I have credit for 90 days, 3 months period. Within 3 months, I can able to make a sale. No, definitely. That is enough. The business is going to be a going concern. That's it. Keep on rotating. That's it. Number two, commercial paper. By the way, business also going to be increased. Commercial paper, CP. CP is also one of the unsecured money or market instrument. It is in the form of promissory note. In 1989, RBI, Reserve Bank of India, issued commercial paper. Highly rated corporate borrowers, live is a source of short-term borrowing to provide additional instrument to investors. That's it. Okay, right. Similarly, in India, corporate, in addition to the corporate primary dealers, all India finance institutions also allowed to have issue commercial papers. Issuing commercial papers, the borrowing loans. That's it. Don't worry about it. Issuing commercial papers means loans. So commercial papers initially CP introduced by the RBI only. Highly rated corporate borrowers only, they can go for CP. So to funding the source of short-term financing, short-term borrowing, so they can go for CP. Now corporates are going for commercial papers. Now primary dealers are issuing commercial papers. All the financial institutions issue commercial papers. They are borrowing loans in the form of CP. That's it. For this, those institutions, those corporates going to be get rated by the CRISIL or ICRA, CARE, Fitch. They are called credit rating agencies. Any company going for commercial paper, they are going to be rated by these agencies. They are called CRISIL, Credit Rating Information Service of India Limited. CRISIL, Credit Rating Information Services India Limited. CRISIL. So Investment Corporation of Investment Information Credit Rating Agency of India, ICRA. Investment Credit Agency of India, ICRA. Credit Analysis Research Limited, CARE. Similarly, Fitch. So these are the credit agencies available in India. They will credit rating you AA plus, AAA plus, AB plus, just like that. If you are having highest credit rating marks to you, automatically the company can issue commercial papers, which means the company borrowed funds, their funds are always safe to the investors. The company always repay the money 100% sure with interest also. They never cheat, because of high credit rating. One company having high credit rating, which means the company never having any default over the repayment of principal and interest. That's called commercial paper. That's it. Number three, bank advances. So bank receive deposit from public for different periods with varying rate of interest. So these funds are bank advances. That's it. Okay. So bank also receive deposit in the public. That's it. Bank advances. Automatically, once the money received by the banker in FD, it is lent by the bank. Automatically, they will lend only. Accepting deposit, lending money. That's the primary function of banker. Accepting deposit, lending money. Now they're going to lend it. Accept a deposit from customers by the bankers. Now they're going to lend it to the corporations, company. But lending is already going to generate revenue for the bankers. It includes interest on deposits. They have to pay interest. So they have to pay interest to the deposit holders. Same time, they have to collect interest on the corporate borrowers. They have to get interest on the corporate borrowers. So they have to pay interest to the depositors. Automatically, for the bankers, administrative cost is going to be happening. By the way, the bankers have a reasonable profit they can make. Borrowing money at a cheaper rate, lending money at a higher rate. So they have profit. So this is the way the bank is earning some profit. Okay, keep the money with you. You can never earn profit. So keep the money. Okay, but if you invested, money can earn. That's it. Okay, so borrow money, accepting public deposits at 5%, lending money at 12%, 7% profit the banker can book. That's it. That's the banker's lending policy. Not only merely profit motivated, at the same time, country's economic development also very, very important. That's why the banker have play a huge role. Social economic development is going to happen through banks only. That's it. Those who are needy of funds, banks are ready to advance. That's it. And finally, T-bills, treasury bills. Treasury bills are class of central government securities. Government borrowing, that's the T-bills, always 100% safe. Who is going to issue the T-bills? Government of India. What purpose? They have short-term borrowing requirements. So T-bills maturity period 14 to 364. So government borrowing, short-term borrowing for a period of 14 to 364 days, it is called T-bills. Who is going to issue T-bills? Treasury bills, Government of India. What is the period of T-bills? 14 to 364 days. So this is government needs some funds, correct? No. So they can issue T-bills. To meet the short-term borrowing, borrowing requirements, come with the banks, the government can go for T-bill issue. That's it. Okay, that's it.